Hey guys, how are you? I'm going to do a sort of like my market review and go ahead and go back through the past year and couple of years. Excuse me. So what you're looking at are all third standard deviations spread across the time frames. I've got 5 days, 7, 14, 28, 34, 68, 90. Um, and you can see that price stays inside these ranges pretty much. Um, and that's how the market trades. Um, so we trade in and out of these distributions and figure out where we are um, on the time frames. There was only two times since 2015 that they broke, and this was COVID. That's when everybody just called their broker and said, "Get me out," right? Broke briefly and then turned around at 200% of the volatility. And once that beautiful vol deceleration back down to my lower levels of the threshold, volatility threshold, sort of normalized, and they went ahead and took the market back up. But you can see that it stays inside the volatility. Before 2022, the volatility had been purposefully um, minimized. I have a scale to 100. Very rare did it get to 100. They minimize the volatility to go to that first standard deviation level at 68, 50 to 68, and then roll over. So you could time your vol sell-offs with this increased volatility going into that first standard deviation. Here was your sell-off, and then once it rolled over, that was where you started buying the dips going back up. And the this 2018 was the second time, and only like since 2015, 2013, look, it always stayed inside the distribution. Um, I go back. I just show you, it just always stayed inside. Even here, that was inside the distribution, went to the bottom, but stayed inside of it. So I go back as far as me being able to get data um, to about 2015. So Powell in 2018 in December broke it right here for his first, I'm going to, normalize everything, and that didn't work out at all for him. Forget that, right? And then COVID. But otherwise, they keep it inside the distribution, including 2022, all this high vol. So that allowed me to lay, you know, behind the support resistance. And every time it got close to testing my quarterly threes, um, like right here, I was able to throw things on Twitter like buy the dip, and everybody thought I was a lunatic because, the market was crashing hard. Nobody in their right mind would think that it would be the turnaround point. Um, Same thing happened here in October. We got to this great um, volatility cycle. I want you to notice what happened in 2022. The vol shifted from being mainly only going up to that 50, 68, being the high uncle point, turnaround, never got to 100. I mean, it just did not happen back in 2022, except for that. Well, it didn't even get up to 100 um, during the Powell pain trade. Um, Here was 2018, and it still didn't get up to 100. It just got to the first standard deviation and rolled over. Um, so now in 2022, we're up to the 100 vol. Powell took it up by sending the market down. But each time it gets to this 100 level, it got up to 120 twice. Peak vol at 120. It rolled over. The volatility would roll over and it would crest down, peak to trough. The low point would go back to this 5068, right? First standard deviation area. And so you could time the market on these volatility cycles whether the vol had peaked and was rolling back over to get to the low vol or the first standard deviation, so then it could get up, go back up to the high vol, go back to the 100. So trade these peaks and troughs. So here was your low vol going short to high. So it's converse to what you would think. You would think that it would be low vol um, long, but actually the low vol was where you would go short on real volatility. And then when it got to the high vol and started rolling over, that's where you would go long here. And again, this was set up for 2022. This did not apply in 21. In 21, you were in the lower volatility framework. So I'm going to, watch the volatility carefully to see uh, if they continue with the higher volatility, keep the 100 threshold in place. Eventually, they're going to start restricting the volatility again. And once it starts trading below that first standard deviation and goes back lower like it used to, like trading down in here, you'll know the framework that they're in. If it's trading above that, then we're trading in a higher volatility framework like right now. So we are not long vol now, we are short vol. We got to the peak and we're on a new short vol tangent, but we got stopped at some of these great quarterly standard deviation levels for support. And so that will be interesting to see what happens going into next week. There is a quarterly roll of the JP Morgan put spread collar. And so going into that March of 2023 expiry, March 31st. So I'd like to see where their put line is. So they buy a put and then they sell two puts below it to finance the trade and they sell a call. And when they sell a call, they can still participate going above that a little bit. And that's where I got my misunderstanding of how the collar worked. Once they cap their upside profit to 3.5 to 5% to the upside, and then they trade down 5 to 20% to the downside. Anything below 20% on the daily, they're losing money. So that rarely happens, very rarely. Um, and likewise, on the upside, if it goes above 5%, they're not participating, so neither does the market, right? The market won't either. Why bother trading it if you're trading by yourself and JP Morgan's sitting on its hands? It just probably won't even go there. So I misunderstood. I thought, they were up here, they're above their call wall. Why not go up to the 12 week? Let me hide that 12 weeks so you can see what I'm talking about. Kind of makes it hard to see this. So there's a 90-day. I'm going to go ahead and remove the visibility for the 90-day and 12 week. and so that we'll only see the 3 month. So it went up to the 3 month to the tick, came back to the 3 month first standard deviation, and I thought that it would go up to 4,300. And so I bought some calls, spreads. Let's see if I can get my call spread right here, and I closed it for a loss. So I had a pretty big loss on my sheet, um, but it was, self-inflicted wound. I thought that they were going to go up to 4,300. I did not understand the dynamics of that put spread collar. They just don't participate above 5%. So now I know. Now I know. So I can trade it correctly the next time. So far, I still have $25,967 open on the sheet. There is one trade that I'm a little bit nervous about. The ES strangle that expires December 30th, Friday. If the 3,700 mean to the quarterly holds, um, this 3,700 is actually, I let me go back and add the other two on it. Put these back on. So you can see what I've done. I've just taken the lowest one and up to the highest one. In the middle of that quarterly range is at 3,700. So that's where I put my put line. If that breaks, this is $1,200 subject to also losing. But it's working out so far. We've got just 4 days. I don't think they'll crash the market next week because that would be like shooting their own client's foot off. So the time to be worried about the market selling off will be after we get back from New Year's, January, February. So the volatility in the E-mini or the ES contract with the term structures looks pretty good. It doesn't look that high going into the end of the year. 20 vol for EWZ2. EWZ2. So if we look at our old pricing sheet, go ahead and put the old pricing sheet up here and change this to EWZ2. End of month, right here, December 30th. And I like to change my contract to Black Shoals on the settlement. And let me go ahead and put 25 strikes on it. And I'm looking for 20 vol. I actually have to put a little bit more strikes on it. So 20 vol, that 2-3 flip is at 37.05. And my in the money, out of the money is at 37.40, 37.45 right here. And that goes from 19. 20 starts about 37.15, but I think I'll have a 3,700, call wall to lean on. So my spread is still okay. I'm not sure if I want to close it at 3,800 and take the profit up to that point. I had 19 days on this trade, so it's almost to the end. Um, so I would only lose a little bit of it if I closed it early, but I'd like to hold it to the end if I could. I'll just see how it plays next week with the volatility going into the end of the quarter. I keep thinking that end of the month, rather, I say quarter, but I mean end of the month. I keep thinking that it's not going to crash below that because, they don't want those portfolios to crash. Our term structure is still high for the futures, meaning in March, they're expecting a higher, close. In fact, at a settlement in March, above 3,900. So they're not going to crash it too far below that. Um, and each, month so far, the futures term structure goes up, and the options open interest for 3,700 heat map. Let me add some more strikes that we can see it. 3,700, 3,690, and 3,670 has a bunch of them. So um, it looks like 3,670 could be a pop and drop. Um, but our contract that we're looking for is EWZ2. Let me see if I can find it. So many on here. Let me just take everything off so we can find it real quick. Oops. Okay, right here. So let me put pardon me, put more contracts on it. Here we go. So yeah, I mean, most of our puts are at 3,700. A couple just below it at 3690, 3675, 3650's got a bunch. But the amount below 3,800 is at 3,700, 6,000. So I just don't think that they're going to crash the market going into year end. I think my little $1,200 is safe. If it does break, um, you know, 3,700, get close to it, I'll probably close that out early. Most of the premium's already been earned, so I'd only be losing a little bit. So going into next year, I think I'm going to have a lot of success trading this model um, by following the volatility cycle, um, going long and short, going long when price gets above the 100 and then rolls over. That's when I'll be looking to go long. And then when it gets up to the top and starts, um, or gets up to the top, comes all the way back down to the trough, peak to trough, and the trough being that first standard deviation on the threshold of my JATS volatility, then I'll take it short again and go to try to get up to that 100 threshold vol. And so I'll be watching for high volatility and seeing if it breaks my 3,700. One thing about these strangles, you don't want to go below, don't ever let them go below your put because it's unlimited, risk below that. So always stop the trade, have a stop loss in. You can always sell another um, 30 day, 14 day, 60 day, 90 day, whatever, or roll in one side. Many different ways to adjust it. But there's also many ways to put on different months and time periods um, for selling premium on these strangles and 90-day. Um, you can see how it gets to the edge of your 90-day. Great location to look for a, you know, futures trade back inside. The distribution trading to the mean or to the other side. So here's your 90-day currently, and let me put a Fibonacci on here. Here's our middle. So I've got a middle at 37.82 and 38.69 for the 5 day, 7 day. So I'm between 37.80 and 38.69 for my two middles. I'd like to see it stay within that area and not dip below 37.89. Going into next week, January, we can have that party and start selling it off, right? Here's my 68-day. Looks like a really good distribution too, to sell premium. And again, the goal of this is sell premium and use that income to get scalps going, and then try to get in on these edges, um, bounces to turn it around and get some great swing trades. Spit it out. So I think I have a pretty good system going now with the framework, volatility framework. And the market sure is structured algorithmically, like my indicator is, pretty well. Here's a another example. It came up to this. I think that's a 90-day one, 12 week. There's so many confluence areas. So there was three levels of confluence right here. A great location for that flip, and you're right here in the flip zone. So that first red down bar on the daily, boy, what a signal that was. So I'd like to try to, get involved more strategically and pay for the trades by selling premium, and see how that works out for me in 23. I think that'll be a good plan. So I'll let you know how it goes. You can come over to the Jats PT Twitter, and let me pull that up for you. And I post charts for the distributions daily, some agriculture, ES, crude, um, as well as NQ. I could post any chart you would like if you would like fixed income or metals, or I don't have much data for Bitcoin. I'll try to get some Bitcoin data. But the 1, 2, 3 levels are also posted. You can right click the image, open a new tab, and that way you can see it closer so that you can get your levels going in for the next week, month, day. And if you would like spreadsheets so that you can get an Excel spreadsheet with the data in it, let me know and I can put you on the distribution list to get an Excel spreadsheet. Um, And that's about it. So some dynamite levels. Uh, you know, here here it is hitting the weekly one and bouncing. Um, bounces or breaks. And a lot of the times they bounce, like right here at the weekly ones, bouncing, going up. That's where it was. So the indexes trade together. So, but that'll do it for our video recap for today. You know, let me know if you'd like a specific market. I can post that for you. I can do more with nat gas or fixed income or metals. I pretty much have crude, NQ, and ES covered. So if you like that, you're going to love Jats PT. All right. Thank you so much, guys. Talk to you soon. See you next week.